what your company strategy is doing is pushing a new product, digital credit.
Yeah.
Digital capital, digital credit. Some say it's the most innovative thing in the world, and a lot of people think it's either a Ponzi scheme or don't understand it all. So what would you say is the most common misunderstood thing that you hear about that?
There's a few misunderstood things. So first of all, Stretch is, we call it digital credit because there's a universe of credit investors, about $300 trillion, actually bigger than equity investors, right? And so if you want digital capital, you buy Bitcoin, you hold Bitcoin. Fantastic. You want a digital equity, you can buy MSTR or you can buy any variety of digital asset treasury companies. If you want digital credit, then we have created a brand new space for that. And why is it credit? Because essentially you're buying, in this particular case, a preferred equity, but you get paid 11.5% annualized yield. So it looks like a credit product. So that's sort of piece one, just as a baseline, because people are like, what the heck is this digital credit thing that you just make this up? Well, no, traditional credit, and now we've digitally transformed traditional credit on the back of Bitcoin. Second piece is people are like, is it too good to be true? Like, I love this idea. I can buy a product that has a relatively stable principal and 11.5%, but I'm used to getting 0.5%. I'm used to getting 3.5%. And so am I taking on outsized risk to get the 11.5%? Because with reward, you usually have to have risk. You are taking on more risk, right? And let's be clear, you're still buying in a capital stack, a preferred equity, sometimes people call it a hybrid, sits between common equity and debt. And so you're buying something that's preferred equity, which means that we take in the capital, and we, the company, do not have a obligation to pay the capital back, right? So the risk is that you're buying into an instrument that the company, the board, Mike and I have the discretion, one, not to pay the 11.5%, and two, not to pay back the principal. Why would you do that, right? Like, why would you take on that risk for 11.5%? And this is the part I think people don't quite understand, is behind the ability to pay that capital, we have $2.25 billion of cash that we put on our balance sheet to make people feel comfortable that there is an ability to pay the principal beyond just, depreciation in Bitcoin, which is unrealized, and issuing shares above a net asset value, right? So we have that. And then behind that, we have $60 billion worth of Bitcoin. So you ask yourself, am I going to get paid the principal, right, back? Well, we have literally $60 billion of Bitcoin on what is now about an $8 billion asset class, right? So I think you're pretty, at least at this point in time, pretty secure that we'll pay the principal back. And then are you going to pay 11.5%? Well, we have $2.25 billion, which at this point is about 18 months worth of dividends. And beyond that, we can also sell our Bitcoin if we need to pay the dividend. So there's this idea that 11.5% is too good to be true. What are the risks? The risks are fairly well disclosed, but we also have what I would call a pretty bulletproof balance sheet behind it, right? And so you got to peel back the layers of the onion for sure, but when you peel it back, we're pretty transparent about what's behind it.
Yeah.
So I don't think it's too good to be true.
Whether you agree with Strategy's approach or not, this is the key thing most people misunderstand. They're not trying to simply hold Bitcoin like an ETF. They're trying to build Bitcoin-backed financial products for traditional investors. Phong Lo keeps referring to this as digital credit because they're taking traditional fixed income products and rebuilding them on top of Bitcoin.
As you said, though, you could choose not to pay it, but that would sort of be the death of the company.
Yeah, there are a lot of things we could choose. Companies pay dividends. They could choose not to pay it, but when they do that, then the stock price goes down, the equity value goes down. Like, why would we? The only reason we would choose not to pay it is if we're in some black swan, the world is ending, Bitcoin is exploding kind of a situation, right? And what I tell people is, what would be that situation? If Bitcoin was to draw down 90% and sit there for 5 years, there would be a situation where we would probably not pay the dividend, right? And if you think Bitcoin is going to go down 90% and sit there for 5 years, that means you pretty much think Bitcoin is going to zero.
It would have to fail, basically.
It would fail. It would go to zero. And if you think Bitcoin is going to fail, don't buy Stretch.
Yeah.
Don't buy MSTR. Don't buy Bitcoin,
Yeah.
right? Like, don't buy digital capital. Don't buy digital securities, equity. Don't buy digital credit, right? And for those who think that, we can argue till we're blue in the face. It's okay. You're welcome to have your views, but then you're also welcome not to buy any of our securities.
Yeah, yeah. That being said, even if I'm a traditional investor looking for yield, I don't really have to know Bitcoin or even trust in Bitcoin. I can trust that you have 2 years of yield payments, and I'll see if something's happening, and I have a year to get out potentially.
Yeah, and that's what's really interesting here, right? For someone to buy Bitcoin today, well, let's go back 5 years ago when we first started this journey, right? In 2020, almost 6 years ago now. To buy Bitcoin was not an easy process, right? You had to create an account, likely with the Coinbase or Binance US or whatever it was back then. You had to transfer your money in there. You had to go through a bunch of KYC, AML. You had to wait 3 days. Maybe the money will show up in a week. And then you actually had to go on, download the app, create an account, all this kind of stuff, and to buy Bitcoin. It was very difficult to do. That was why MSTR was interesting to a lot of people. It was an on-ramp to Bitcoin. Okay, put that aside. Now today, right, the process of getting 11.5% yield on your money is as simple as opening a Robinhood account, buying STRC, and being done. You don't need to understand Bitcoin if you don't want to. You do need to understand the company and what a preferred is. And that's what's really interesting about this product, right? We knew this was going to appeal more to the masses than MSTR or BTC, right? If you look at MSTR today, it's about 40% ownership by retail. If you look at STRC, it's 80% ownership by retail.
Wow.
So these are folks, and we started to look at the investor list in a lot of detail. And it's not, if you look at our top 10 shareholders as an example of Stretch, I believe it's around 10% ownership of Stretch, which is a very small amount. Usually your top 10 shareholders of a common equity might own 30%, 40% of the common, which means that this is a product that is being sold to the masses in the US who are buying $1,000, $5,000, $10,000 at a pop, which is fantastic. That's what we wanted. And I would guess, without knowing exactly, that a lot of these people are just looking for the yield, right? And they don't know much about Bitcoin at all, right? And that, for Bitcoiners, that's awesome, right? Like we're on-ramping people into Bitcoin because obviously what we do is we take those proceeds and we turn around and we buy Bitcoin and put it into the Bitcoin ecosystem. And so we're now finding a way to on-ramp people who otherwise wouldn't access Bitcoin or Bitcoin, treasury companies to buy digital credit.
This part is really important because it shows where strategy sees the opportunity. They're not just targeting hardcore Bitcoiners anymore. They're targeting traditional investors who simply want yield, and whether you like it or not, that's how mass adoption usually happens. Most people use technology long before they fully understand it.
If you think about that sort of person, everyone probably pictures a grandparent or parent who's 75, probably has 10, 15 years left to live, and they, let's say they've done pretty well in their life and they have $2 million, saved up. And most of them, if you look at most retirement calculators, right, like how much do I need to retire? You ever seen one of those calculators?
Yeah, and you get 4% a year.
If you're lucky, it assumes 4%, and you're eating down the principal.
Yeah, you die
so
with
that
zero.
when you die poor. You die with nothing. That's your goal.
Yeah,
right.
I hate that goal.
It's such a terrible idea.
Yeah.
Because if you get the math wrong, you're screwed, right? Oh,
or if you have a multi-year drawdown.
Yeah. Or if I live for 4 more years, I'm done.
Yeah.
You don't die poor, you live poor for 4 more years. So these retirement calculators, I found them comically bad.
Yeah.
What you really want to do is if you have $2 million, you want to live off, if you can get 11.5% off the $2 million, you want to live off the $200,000 and keep the $2 million there into perpetuity so that you can live to the age of 110 if you want to.
Yeah.
Or have something to give to your kids.
Yeah.
Right. And the beauty of something like this is because it's tax deferred. That's $200,000 of real tax. You're not paying taxes on that money. And by the way, as most folks know, the way return of capital treatment works is when you take Stretch, let's say you have it for 10 years, the cost basis goes to 0, and then you give it upon death to one of your children, cost basis steps back up, and you get another 9, 10 years of tax deferral. So I do think it's an ideal product for folks like that. And we get a lot of flags like, no, that's a terrible recommendation. Like, why would you recommend somebody? Because you could lose all your principal. That's fair, right? That's the downside sort of black swan scenario is the $2 million goes to zero if stretch prices from $100 to zero, right? But what I do is if you see us starting to burn down that cash reserve and it's like at 2 months, sell the product, right? And then go, but until then, you had your 11.5% returns.
And the same thing is true with any fixed income instrument. So I'm going to buy a dividend stock from AT&T. I mean, their business model could be disrupted, or I buy a bond from Google and AI disrupts. I mean, so the same is true. There's always that same risk.
Yeah, there's risk. Buyer beware for sure. Our disclosures are very clear. In fact, you could argue like those other instruments you're talking about, ATT is a great example. You get to see their business results every quarter. You get to see our business results every week because we put out an 8K of what we've done. And you get to see within the week, you go out to our website and you get to see every disclosure you ever want, right? You can decide when it's time to get worried and get out of the product. So I agree. It's I think it's a very good option for a retiree not to die poor.
This is where Strategy's thesis becomes really disruptive. They believe Bitcoin can eventually support an entirely new retirement and savings system, one that performs better than traditional bonds or savings accounts. Now, obviously, this comes with risk, but that's the vision they're selling.
So now let's go to MicroStrategy, MSTR, or Strategy, MSTR. So MSTR, to me, it looks like this factory, as Michael Saylor would call it, where you're taking in, raw Bitcoin and then creating like this digital credit product on there. It seems pretty apparent to me, but a lot of people think that you're just an ETF and you're just holding Bitcoin. And why would you ever trade for more than one times?
Yeah. There's always this, since you asked, what are the haters saying, right? There's either you're just an ETF or you're a Ponzi scheme. So why don't we cover both of those, right? Like, first of all, if you want an ETF, you can buy IBIT or you can buy MSBT now. Morgan Stanley put out what is a 14 basis point fee ETF, right? When we first started this in 2020, we bought and held Bitcoin. And that's all we did. We had a software business and then we bought and held Bitcoin. And so at that point in time, we should be valued at 1x our underlying asset, which was Bitcoin. Makes sense, right? We then started to lever up, right? And levering up means we took on convertible debt, secured debt. And if we lever up, we were able to then buy more Bitcoin, right, on leverage. And at that point in time, when you lever up the company, if Bitcoin is going up, right, if the underlying asset's going up, we should go up more. It's fairly simple, right? Like, and so if you're able to lever something up, you should trade at more than the underlying asset, right? As you grow that leverage and as the underlying asset grows in the value, we should trade at more than that, right? And then we did something interesting, which was a better form of leverage, which we call amplification, which are these preferreds, where we're not diluting the common stock. We're not taking on actual debt that has an obligation of repayment. And so that's amplification. And as we buy more Bitcoin through amplification, we should trade it an even greater than 1x MF. Another way to think about it is, what are we doing? We're increasing Bitcoin per share. Right. And what I tell people is if you buy an ETF, if you buy one Bitcoin's worth of an ETF, right? Let's say you put whatever it is, $78,000 into an ETF, and you get one Bitcoin. That's basically what you get with your $78,000. I guarantee you, at the end of the year, you will have access to one Bitcoin. Right.
Or less because you pay the fees.
You pay the fees, so you have a little bit less than one Bitcoin.
Right.
That's it. That's the bottom line. One Bitcoin in the beginning of the year, one Bitcoin minus the fees at the end of the year.
Right. So a little less.
Yeah. If you buy access to one of Strategy's Bitcoin at the beginning of the year, right? Like if you buy access to one of our Bitcoin in one Bitcoin per share, right? Like, and at the end of the year, what we've delivered every single year is more Bitcoin per share. So if you bought one Bitcoin's worth of MSTR stock at the beginning of 2024, at the end of the year, you had 1.78 Bitcoin's worth of MSTR. Right. And so we're increasing Bitcoin per share. Yeah. And so if you are getting access to more Bitcoin per share with MSTR than you are with IBIT, shouldn't we trade at a value greater than the underlying.
Yeah.
At the point where we stop increasing Bitcoin per share, or, for some reason we have to sell our Bitcoin and we decrease the Bitcoin per share, then we would start to trade at a value less than that. And that's just, I think that's just finance. That's just math.
Yeah. The difference is, I guess, with the operating business, then you trade a multiple of that book or the MNAV number. So then while you're getting more Bitcoin per share, it could trade at a lower multiple. No different than an equity would trade at a PE ratio. And so that PE ratio goes up and down. So while I may be gaining Bitcoin per share, the multiple goes from a 2 to a 1, and I've lost capital off of my equity valuation, versus an ETF sort of stays the same.
Yeah.
So that's one thing. I have to deal with more volatility.
Yes. Yeah. And of course, you're right. Like with leverage comes volatility. Right. Because you're leveraging the underlying, and therefore you're getting more volatility of the underlying, which is why, if you look since we started this effort, Bitcoin has gone up about 38% a year since August of 2020. And it's had a vol of about 40%, right? Vol of 40, right? And we have gone up about 55% a year with a vol of 60, right? So yeah, you're getting more amplification, but you're also getting more volatility.
Yeah. So when you think about that, then it's kind of basic math. If you add leverage, you're going to outperform Bitcoin.
Yeah.
If we both buy one, we both go up the same. But if I put leverage against mine, I'll go up faster.
That's right. I mean, and if Bitcoin goes down, you're going to underperform Bitcoin.
That's right. Yeah. Now, I remember a year ago, Michael Saylor was saying that the market sort of expects you to trade maybe a 2 times vol to Bitcoin, and so that should mean that you should outperform because of the leverage, but also means I should expect you to underperform if Bitcoin goes down. So if Bitcoin drops 40% and you go down 80%, is that something that you would sort of expect? You're not trying to do anything to hedge that?
It would, and we're not trying to hedge, and I think there's a mathematical component to vol, and there's a sentimental component to vol.
Yeah.
So I can calculate the mathematical expected volatility of strategy based on our Bitcoin per share growth, our Bitcoin yield, and our leverage and our amplification. I cannot calculate the sentimental aspect of volatility. That is also driving the value of the stock price. But I think 2x is not an unreasonable amount, because that has been our observation. Now, we've seen that compress more to about 1.5. 1.5 the performance of Bitcoin, 1.5 the vol of Bitcoin. Right. And so that seems reasonable. And engineering volatility up through leverage, is fairly easy. And we were talking about stretch. What we've done with stretch is we've actually engineered volatility down, which is actually harder to do. And so we've taken a product, Bitcoin, that has a vol of 40, and we've actually engineered it down to 2.
Right.
And when you take a return of 38 with a vol of 40, and you engineer it down to a return of 11 with a vol of 2, you've actually increased significantly the Sharpe ratio, which is the return above the risk-free rate divided by the volatility.
Right.
So that's actually a more interesting mathematical and engineering feat, what we've done with stretch, than what we've done with MSTR.
This is probably the clearest explanation I've heard for why strategy trades above its Bitcoin holdings. The core idea is simple: an ETF gives you static Bitcoin exposure. Strategy believes they can continuously increase Bitcoin per share through leverage and financial engineering. Of course, critics would say that also introduces additional risk and volatility, but that's exactly why MSTR behaves differently from spot Bitcoin ETFs.
I know Michael Saylor is sort of the guy that's out there in front of everything. You're behind the scenes having to build all this, which is way more difficult than just talking about it, I'm sure. I mean, they're both equally important. But I'm curious, one of the things he talks about is sort of simplicity of messaging. And so I know you rolled out 3 prefs before, strike, stride, and now you have stretch, which seems to have found that real product market fit. It also seems like it aligns with that simplicity of messaging. So MSTR buys Bitcoin, we digital capital, we create digital credit with stretch. Stretch is easy, it's a bank account that pays you 11%, boom. So how important is that for you as a company building that out? And does that mean that strike, strife, and stride, I don't really hear them being talked about anymore? They're complex products.
Yeah. So first of all, on the simplicity of messaging, right? Apple was obviously has proven over multiple decades that the simpler and easier to use a product, the greater the demand, right? And if you look back 10 years, they had essentially 5 products, right? And they at that point in time, 10, 15 years ago, had only 5 versions of the iPhone. Now they have dozens of products, dozens of versions of the iPhone, and I think they wavered off of the simplicity messaging. But all that said, they proved that a simple product that is easy to understand is the one that's going to sell. Because we go back to, Bitcoin, an amazing product, simple and brilliant in its design, is difficult to explain, right? And Stretch is a very simple product to explain. Now, getting to something simple is a lot harder than getting to something complex.
Yeah.
Right.
Perfection is when nothing else can be stripped away, right?
That's exactly right. Yeah. And so there were a few reasons why we went through iterations of Strike, then Strife, then Stride, then Stretch. The first reason is just pure ability to launch a novel product into the market, underwritten by banks who want to ensure that the product will be successful, right? And so as a company that was very well known and had essentially saturated the convertible bond market, the first preferred that was backed by Bitcoin that was going to be perpetual in nature was novel enough. And so the banks that we work with said, to seed this novel product, we need to get the convertible folks to buy it. And therefore, let's make it a convertible preferred, right? That's why we launched a convertible preferred day one. It wasn't because we wanted to make it convertible, but we felt that making the product successful, getting all the existing convertible buyers who trusted us to buy it, we started with a convertible preferred, right? And so that was clearly going to be the first one. It was successful, so we said, now can we do one that's not convertible, right? And that's what Strife was basically a preferred that had a fixed rate, 10%, that was not convertible. And we said, okay, good. Now we said, okay, can we launch something that doesn't have the governance rights that our senior Strife and Strike do, that is for the masses, right? And that was the purpose of Stride, was a fixed rate, no governance rights, non-cumulative, junior, and that was to be for the masses. And we launched it, and it was pretty successful. But when we said, hey, 4th try, how do we make this really, really simple? What the masses want is not a product where the principal goes like this and the rate stays stable. We flipped it and said, let's keep the principal stable and the rate goes like this. Back to the retiree who has, 5-10 years that they don't want their principal to get cut by 30%. Right. They want to know that they're going to get paid 10.5, 11, 12, whatever percent every single month, and the principal is going to stay flat. Right. That was the epiphany, and that's why we launched Stretch. And it was very much one of those cases where, as we put the products out in the market, we started to realize what the market really want because we got market feedback. Right. So that was useful. Now, why don't we talk about the other products, right? The Stretch product is built to perform regardless of Bitcoin price, bull bear market. You're seeing it right now. It's been through a fairly significant bear market where Bitcoin price dropped 50%, and Stretch is sitting right around $100. Right? It's actually quite phenomenal. As an experiment in the capital markets, and I know you're a capital markets guy, it's a pretty cool thing to watch this happen.
And you actually climbed up to par sort of during the bear market.
That's exactly right. And we had to increase the interest rate, but it did what we were hoping it would do, which is quite phenomenal. So now, the other products are built to perform in a bull market.
Right.
So what I'd like to think happened, and you saw this actually happen in the first half of last year. It was a bull market, and we saw products like Strike and Strife start to build up to 110, 120, and then we issued more of it. I do believe as we enter a bull market, you'll see these products start to perform. People will make money off of the principal appreciation and the dividend, and we'll be talking a lot more about those products. But they're the bull market products.
Got it.
And Stretch is it doesn't matter what the market product is. So I do think if you're sitting here, and there are people buying into, as an example, Stride, which is trading at like 80, right? But the dividend is still 10%, which means the yield you're getting on that is actually 13, 14%, right? And so if you're a little bit of a longer term holder, Stride, you might argue, is actually a better investment than Stretch because you're going to get a 14% yield and you're going to get potential appreciation from 80 to 120 or whatever it is. You might get a 50% appreciation in a bull market.
Right.
Not suggesting that everyone go do that,
Yeah.
but that is an alternative to buying Stretch.
Right. So if your time preference is a little bit lower, if you can wait longer and handle a little bit more volatility, you could actually earn more yield with potential upside, but there's also more potential downside. More like a dividend-paying stock where you're going to get the capital appreciation of the underlying stock plus the yield that it pays you. Yeah.
What's interesting here is that they're treating Bitcoin financial products almost like software products. They launch a version, collect feedback from the market, iterate, simplify the messaging, then relaunch. That's a very Silicon Valley approach to finance.
One last question. Let's not go too far out. I think Michael Saylor's talked about, so you're probably on board, but like, hey, we think in 10-year chunks, but it's pretty hard to see after 20 years. So where do you see where do you see strategy being in 20 years?
So I think the next big thing that's going to happen in the next year, 2026, is the integration of decentralized finance and traditional finance. And I've talked about that a lot. I think companies like Morgan Stanley, like Citibank, are leading that charge. And what will happen next year is the tokenization of securities, right? And when we are able to tokenize Stretch, or we're able to tokenize MSTR, or Apple or Tesla or anything else, you lead to direct access to 6 billion people for our securities all around the world, which, if you see the intersection of decentralized finance and traditional finance, and then the tokenization of securities, that means that Bitcoin will increase its importance and access around the world. Right? Imagine if 6 billion people can buy Stretch, or you can pull out your phone, I can pull out my phone, and I can tap your phone, and I can sell you at $100 one share of Stretch. Now imagine if I could do that via WhatsApp with somebody that is living in Vietnam or Korea.
Yeah.
Right? And so what you'll start to see is this convergence of decentralized finance, traditional finance. So if I look at now let's talk about 10 years out. 10 years out, we have a finance world that is fully, decentralized finance, has eaten up traditional finance, and Bitcoin becomes the digital reserve asset of the world, right? It'll be as important as the US dollar. Governments around the world will be owning Bitcoin. They'll own gold. They'll own the US dollar, and we'll be the largest holder of Bitcoin in the world.
Yeah.
That's sort of the world I see in 10 years. And, what's happened in the last 2 years and next year, I'll call it the 3 years, 2025, 26, 27, we'll look upon as the most transformative time. It'll be the digital revolution, right? 10 years from now, people will look back and think, it's just, what do you think about the internet today? You don't think about it as this revolutionary product. You just think about it as its existence.
Yeah.
The internet is. The internet wasn't invented, it just is.
Yeah.
People think about that about AI 10 years from now. Nobody will be debating whether AI is good or bad.
Yeah.
AI will just exist.
Yeah.
10 years from now, people won't be debating, is Bitcoin good, is Bitcoin bad? It'll just exist, like the US dollar. And if that's true, we'll be the largest holder of Bitcoin in the world.
Yeah.
It's pretty awesome.
It's going to be pretty hard for anybody to pass you. So since you can't probably say it, here's what I think. You're going to have at least 1 million Bitcoin. Maybe in 20 years from now, you have 1.5 million. Maybe it's 2 million Bitcoin. It's going to be over 1 million, that's for sure. Bitcoin's price in 20 years could be 15 million. It could be more. So simple math, 15 million times 1 million Bitcoin, 15 trillion. Maybe you get a 2 times book value, MNAV.
Yeah, like
we're talking one of the most valuable companies in the world.
If Bitcoin is the most important digital asset in the world in 10, 20 years, and we're the largest holder of Bitcoin in the world in 10 and 20 years, you can make an argument that we would be the largest company in the world in 10 and 20 years.
Whether strategy succeeds long-term or not, this interview shows how ambitious their vision really is. They don't just see Bitcoin as digital gold. They see Bitcoin becoming the foundation layer for a completely new global financial system. And if that thesis ends up being correct, companies like Strategy could become some of the most important financial institutions in the world, Do you think strategy is building the future of finance or taking on too much risk? Comment below. I genuinely want to hear your thoughts. And if you enjoy long-form Bitcoin breakdowns like this, subscribe to the channel because I'll be posting more interviews and highlights like this every week.